Thank you very much for inviting us to present this paper today. Border adjustments are policies that tax all imports while allowing an equivalent deduction on all export sales. They are a recurrent topic in policy debate, and they were a hot topic on the news last year during the negotiation of the corporate tax reform. Indeed, in 2016, the Ryan Brady proposal advised to charge the corporate tax on all imports of the US while allowing a deduction of the corporate tax on all export sales. Now, this particular feature of the policy was dropped from the bill in 2017 because of pressure from importers and because of uncertainty due to its economic effects. Another typical policy that involves a border adjustment is a value-added tax. And this is because a value-added tax is usually levied on all imports and rebated on all export sales. This is also another policy that in the US context is often discussed, especially in alternative to other sources of revenue that the US government may use. Now, at this point, it's important to note that we're going to analyze an introduction of these two policies that differ in one important aspect. In one case, we are applying a border adjustment on an existing tax, the corporate tax. In the second case, we are introducing a border adjusted tax that is a fresh introduction. So they seem pretty straightforward superficially, but they have complex effects in practice. And these effects are often misunderstood even among economists. So we hope to shed light on the macroeconomic effects of these policies. And we're going to set aside important issues related to long-term effects. For example, these incentives to profit shifting and business location that the border adjustment is supposed to influence. Border adjustments are often perceived as protectionist. Ironically, economists have long known that border adjustments they're exactly the feature that undoes protectionism. For example, in the case of a value-added tax, if we didn't apply an export rebate, that would be equivalent to applying an export tax in case we assume inelastic labor. And the Lerner symmetry result tells us that that is equivalent to applying an import tariff, at least in its real economic effect equivalent. Similarly, for the corporate border adjustment tax, the Lerner symmetry tells us that we are applying two offsetting taxes when we border adjust the corporate tax system. And that should also have no real economic effect, or in other words, it should be a neutral introduction of this border adjustment. And the intuition behind this is that when we are applying a border adjustment, the wedge applied on import and export prices should be compensated either by a domestic wage response relative to foreign wages or to an exchange rate response. So the original conditions for the Lerner symmetry relied on flexible prices and trade balance. These conditions are often met with skepticism because they rely on the fact that we're having multiple price changes in general equilibrium offsetting these taxes. So a natural way to approach this topic and to approach this skepticism from us was to take a step back and think again of more general conditions for this neutrality result to hold. And then after finding these neutrality conditions in general, look at where they're more likely not to hold, and then find a quantitative effects out of this relaxation of neutrality conditions. So we find five of them in a new Keynesian dynamic setting with sticky prices, sticky wages, and intermediate goods, and trade imbalances to reflect the modern economy. And these five conditions are the following. They should hold all together in order for the neutrality result to hold. The first of all is that there should be symmetric pass-through for taxes and exchange rates into prices. The second is that the country introducing the corporate border adjustment should have only international asset position in foreign currency. Then the monetary policy should follow a pretty much standard Taylor rule, and it's important that it doesn't target exchange rates. In the end, this border adjustment should apply uniformly to all imports and exports, and it should be one-time and unanticipated. For the value-added tax, exactly because in this case we are introducing a new border-adjusted tax, we are not introducing a border adjustment to an existing tax, then there is also another stringent condition that we need to add to the 5 above, and that is that labor supply should be inelastic. So in the paper, we analyze more or less all of them and departures from all of them. But in today's talk, I'm going to focus on the first two specifically. And then for the value-added tax, we're simply going to calibrate a standard Frisch elasticity of 0.5 to have a plausible response of the labor supply. So let me give you more details on what the first condition, what we mean with the first condition. So I'm asking you to visualize here the dynamic of prices in the US at the border and in world prices when a corporate border adjustment tax is introduced. Assume that prices are sticky in the currency of the producer in this context. So in the case of US imports, prices will be sticky in the foreign currency, and that is denominated with a superscript star. When this good is sold in the US, that price is converted in dollars with a variable epsilon, meaning amount of dollars per foreign currency. And then the border adjustment is applied, and that border adjustment, because prices are sticky, is passed through right away into consumer prices. This is what we mean by having symmetric pass-through of taxes and exchange rates. You can see here that the only variables that moves are the ones highlighted in red. And so the condition is matched because exchange rate movements and the border adjustment are passed through right away. Similarly, for exports, the domestic producer in the US prices goods in dollars optimally, and that price is sticky. When this good is sold abroad, then the corporate adjustment deduction is applied and passed through at the border completely. At this point, it will be converted in units of the foreign currency with the exchange rate variable, and then again, we have that this condition is met for consumer prices of the rest of the world as well. You can see now why we have this condition implying neutrality here, because in general equilibrium, the exchange rate, as long as it perceives a complete appreciation, will completely offset the corporate adjustment tax. And you can see also here that this condition is more general than the original derivation of the Lerner symmetry, because we don't have flexible prices here. We can even have fully sticky prices, and the neutrality result will still hold. However, there's a problem with this rigidity assumed here, and it's the fact that as more evidence comes through on the rigidities in trade markets, the producer currency pricing approach is rejected. And what seems to be a more accurate way of representing rigidities in trade markets is what is called the dominant currency pricing approach. In this context, prices are sticky at the border for dollars, both in imports and exports, so in the domestic currency of in the case of the US. We know this because 97% of US exports and 93% of US imports are priced in dollars, and we know that a large majority of them are sticky in dollars. So when the border adjustment is applied in this context, the neutrality will fail. And this is because the exchange rate, the dollar appreciation, cannot pass through into import prices right away. So in the short term, for US consumers, only the border adjustment tax will do the work. And this means that imports will have a higher tax, the price will go up, imports get killed. And this sort of justifies the concerns that importers had related to the introduction of this border adjustment. For exports, similarly, the prices are sticky at the border, and so now it is the deduction that cannot pass through world prices. And so that those world prices will change only according to the exchange rate. Now, this particular departure of the neutrality condition breaks neutrality only in the short term. In the long run, we assume that prices are flexible again, and so we will still have neutrality in our quantitative section. The second condition that we imply for neutrality is that all international assets and liabilities of a country should be in foreign currency. You can see why this matters just by looking at the budget constraint of the US expressed in foreign currency. Now, the net foreign asset position is fully in foreign currency, and there will be no change after an exchange rate appreciation, after a dollar appreciation. And for the trade balance, also there will be no change in value because the export subsidy or the export exemption of the corporate adjustment tax will be completely offset by the dollar appreciation. But we know that this is not an accurate way of modeling the net foreign asset position of the US. In particular, we know that most of US liabilities are denominated in dollars. And so we must enrich this budget constraint and with a new variable called B here, highlighted in green, because it's denominated in dollars. And when we introduce this variable, then an exchange rate appreciation, a dollar appreciation, will increase the amount of liabilities compared to assets for the US in this case. This is equivalent to a transfer of wealth from the US to the rest of the world. That is, we calculate B equal to 1.09 multiplied by the amount of the appreciation in percentage points in general equilibrium. And we're going to be able to give you a number for this after the quantitative section. So let's look at the quantitative effects. In this slide, I show you the impulse response function after an introduction of a border adjustment in the corporate tax system of the US on the first quarter. This border adjustment is one-time and permanent. So let's look at the producer currency price case here, in which both of our assumptions hold. In that case, we've seen that the neutrality hold. And this implies that the exchange rate, the dollar appreciation is complete, is 20%, exactly equal to the border adjustment rate. And that will have no effect on export-import volumes or output volumes. Now, what's more interesting is to check what happens when we, under the more plausible assumption of dollar currency pricing. The dollar appreciation in equilibrium is still close to 20%. But imports and exports behave differently. In the case of imports, this dollar appreciation cannot pass through US prices right away. And only the border adjustment in the short term will increase import prices and will trigger a 30% volume drop for imports. Similarly for exports, now it is the subsidy or the exemption of the corporate tax that cannot pass through world prices. And all the work is being done by the dollar appreciation. Output just increases moderately. When both assumptions that we find are not met, so when we assume a dollar currency pricing world and the possibility of a valuation effect, then the exchange rate appreciation is at only 15% in the short term. And this is because there is a wealth transfer from the US to the rest of the world. Now there is an asymmetric effect on exports and imports. For imports, it doesn't matter that the dollar appreciates less than under DCP because prices are sticky in dollars. But for exports, that lower appreciation will imply a 20% drop rather than a 30% drop under DCP. And this will boost the trade balance, will turn into a trade surplus for the US, and that will boost output by almost 2% as well. So let's now give some estimates for the valuation effect and fiscal revenues. Now we know that the appreciation under valuation effect is of 15%. And so we can calculate that there will be a wealth transfer from the US to the rest of the world equal to 16% of GDP under border adjustment. Fiscal revenues were also a hot topic during the discussion of this policy. The intuition behind its effects is that when we are shifting from a standard corporate tax to a border-adjusted corporate tax, we are changing the tax base from exports to imports. And so in the case of the US, where the US is running a trade deficit, we are shifting towards a bigger tax base. We're shifting towards imports. And so in the short term, while the US is running a trade deficit, there will be a revenue boost that we calculate being equal to 4 percentage points of GDP. In the long term, though, in order to keep the negative negative net foreign asset position of the US, that trade balance, the trade deficit should turn into a trade surplus. And so in this case, the border adjustment on the corporate tax will be equivalent to a drop in revenue of 15 percentage points of GDP. Now, let's look at the second policy that we analyze, the value-added tax. The first condition for neutrality is similar in spirit to the border adjustment tax. There should be complete pass-through of value added into prices in the short run. If you look at import prices related to the aggregate domestic price, you can see why this ensures neutrality. As long as the value added tax is passed through completely on both imports and the domestic prices, then there will be no effect on import demand. For the case of export, exactly because this is a new introduction of the value-added tax, nothing will change. And so the relative prices of US exports related to the foreign prices of goods will not change. Notice that because this is a new introduction of the value-added tax and not a border adjustment of it, then there will also be no exchange rate pressure. And under neutrality, we don't expect a dollar appreciation. But we do need an additional assumption, which is stringent, fairly stringent, which is inelastic labor supply or fully rigid wages. And this is because the value-added tax will increase domestic prices, and that will make real wages drop and hence trigger a labor supply response. So let's look at the quantitative effects. Under inelastic labor supply, we find almost by construction that there's no effect, right? But then when we assume a standard Frisch elasticity of the labor supply of 0.5, there is a large output drop due to the response of this labor supply. In the case of the dollar appreciation, the appreciation is fairly small in general equilibrium, and so there will be little implication for the volume of trade as well. In conclusion, we find more general conditions for the neutrality of corporate border adjustment tax and value-added tax, but we find them to be unrealistic. On the first quarter impact of a 20% corporate border adjustment tax, which is a border adjustment applied to an existing tax, we find that there will be real effect on trade volume of minus 30% and also a large appreciation in equilibrium. For the case of a new introduction of a border adjusted value-added tax, the main effect is on output, and there is a drop of 5% on output, but there are moderate effects on trade volume and dollar appreciation. For the case of corporate border adjustment tax, the valuation effect is equivalent to a 16% wealth transfer from the US to the rest of the world in terms of GDP. And fiscal revenues have a short-term boost of 4 percentage points over GDP with a reversal in net present value in the long term, so of 15% percentage points over GDP of revenues. Thank you very much.